Good day, fellow investors. ASML just reported earnings. We have it on our risk and reward quadrant, and I have it here as offering a good return, but still on the riskier side of things. Now, the stock has declined significantly, especially over the last 10 months. 42% down. Today it's also a little bit down, tariffs, issues, but what I want to see as an analyst is to differentiate between short-term uncertainty, tariffs, this or that, and the real risks affecting the business model, the moat, the long-term durability, competitive advantages, and profitability around it. Because the market is focused on the uncertainty, we as value investors are focused on the long-term strength of it, and that market's focus on uncertainty gives us the opportunity to buy great businesses at low prices, as we have seen with the 40% decline. Let's go into earnings. We have stable earnings, 7.7 billion, going towards 30, closely to the more negative guidance for 2025. If I look at sales, this is worrying Wall Street. Wall Street expected higher net bookings, but for the rest, the profitability is there, the margins expected going forward are there, the net income is there. The CEO says that, okay, it is highly uncertain times with tariffs. However, they still see 2025 and 2026 as growth years for the company. And then everything, of course, is based on that AI, on the semiconductor industry. And they still expect artificial intelligence adoptions across an expanding application space and is expected to surpass 1 trillion in revenue by 2030. On those notes, they still expect, depending on the scenarios, their annual revenue to be between 44 and 60 billion with a gross margin between 56 and 60, thus also increasing gross margins going forward. If we look at the net sales, we will likely, if they hit 30, that is already indicative because that means that there is no real growth here, but they are still positive. Maybe they will hit 35, that would be a positive, maybe not, but we can make the calculations on the less exuberant or the more exuberant guidance, but we need to look at things long term. Here on net bookings, I see here now that those are a little bit volatile, thus we cannot take it as a factor. Let's analyze things. Let's put it into our intrinsic value. Earnings per share 19, likely will be 20 this year. And let's go to our intrinsic value. You can download it in my free investment course in the link in the description below. I'll update the numbers after I do this video. And let's go to ASML. So we click here and now we have to put inputs. Earnings per share, let's say 20 euros for this year. Now we have to see the dividend payout ratio, the growth rate, and then estimate a P ratio down the road at the end of our analysis. And then we have also 3 scenarios that ASML is giving us. Now, I'm looking here at earnings at 20. If I look at the cash returned to shareholders, we see that they are giving a 6.4 euro dividend, thus that is approximately 30% payout ratio. Most of the money is going towards buybacks, 2.7 billion, likely 10 billion buybacks per year on the current 220 billion market cap. That is also a buyback yield of 4.4%. And we have 3 scenarios. The exuberant scenarios, doubling revenue over the next 5 years. The next scenario, the mid scenario, 75% revenue growth. And the worst case scenario for the company, just 50% growth going forward. And we have to put these numbers connected to the earnings per share. I'm going to always be a little bit more conservative, But let's go here, dividend payout ratio, I have to change it to 30, so this is the money that we are getting as dividends. Then we need to look at the growth rate. The midterm estimate was for 75% growth, thus I need to have this 2030 earnings at around 35. So the growth rate should go higher there. If I put 10%, here we are, 2030, 35 earnings per share, and then we can estimate a little bit slower, just 8% going forward, 10% expected return, and the terminal multiple, as I said, always conservative of 15. However, don't forget, they are doing buybacks. Buybacks increase number per share, thus we have to add here 4 percentage points of growth for the buybacks benefit, and let's say put 10 to be a little bit more conservative. That means that it will grow 14% in the medium case scenario. The intrinsic value for a 10% return there is 395. If we go to the best case scenario, these earnings should be 40 when it comes to 2030, thus I go to 12% growth, 13% growth, there we are, 40. On those 13, I have to add 4% of buyback yield, and here we are with the buybacks at 48 earnings per share. Let's say that after year 5 they grow just 10% with the buybacks and everything, a conservative terminal multiple of 20, and now we are already, in the best case scenario, we are close to the stock price now, actually around there for a 10% return. Worst case scenario, just 50% growth to 2030, that is 8% growth, and then I can be conservative, just 5% growth going forward. Terminal multiple, let's put 12 in, I don't know what kind of environment, but it might happen. And then I have to again add the buybacks, that's 12, and let's put 7 here. And then the present value would be 275, which means still plenty of room to decline. But this is the risk and reward. However, there is another positive here. AI, semiconductors, those are driven by sentiment a lot on the markets. And I think that maybe there will be bad sentiment, maybe worse. However, at some point in time, over the next 5 years, given the industry's nature, there will be exuberance. At that point in time, ASML will grow and will again have a terminal P ratio of, I don't know, 30. Perhaps even more. And then at that moment you see that just that P ratio changes the present value here exorbitantly. Or if I take the 2030 earnings here in the best case scenario, 50 times 30 is 1,500. So no matter what happens, you have to always accept the cyclicality of it. Sooner or later, I think the stock will hit 1,000. Therefore, based on the exuberance and the sentiment, now it still looks like a good buy. However, you have to accept the volatility. This would make it already interesting also for me, because with those conservative estimates, understanding the long-term trend, then it would make it very interesting. Now, it is already interesting, however, you have to accept the volatility that it might also go to 400. This is also possible in a disaster scenario, but could also happen. So you have to balance your risk and reward. I'm going to leave it here as 12% likely return, some margin of safety on the semiconductor cyclicality, boom and bust sentiment, exuberance and panic, but still the business is there, the growth is still there. So it looks like an interesting already opportunity. The lower it goes, the better it looks. That's value investing. Subscribe for more. I'll see you in the next video.